In the 1970s, inflation didn't really scare anyone, at least not at first. Everyone thought, it's temporary, it'll rise a bit, then it'll fall. Just a side effect, the cost of growth. Until 1979. That year, the revolution in Iran changed everything. Oil prices went up, sure, but that wasn't the main story. The global financial system had laid bare its fragility. We could no longer think we could manage inflation with gentle adjustments. Central banks had to make a choice: political comfort or economic trust. And in that moment, the modern global economy took a completely different path. Don't just see the 1979 oil shock as a spike in energy prices. It was the moment the system had to face its own weaknesses, because it wasn't just about oil. It was about expectations, credibility, and the cost of restoring trust once it's lost. Actually, the story starts a bit earlier. In 1971, Nixon ended the dollar's convertibility into gold. He shut down the Bretton Woods system. Dollars were free to float. Before, currencies were pegged to gold. Now, discipline had to come from elsewhere: central bank credibility, fiscal responsibility, political stability. But in the early 70s, that discipline was weak. Very weak. Then came the first oil shock in 1973. OPEC imposed an embargo on the U.S. and some Western countries. Oil prices quadrupled in just a few months. But notice this: it didn't create inflation. It amplified the inflation that was already there. And in those years, the U.S. met something it hadn't seen before: stagflation, high unemployment and high inflation. The old economic textbooks had no answers. By 1979, the Iranian Revolution exploded. Oil production dropped sharply, and prices more than doubled in less than 2 years. Inflation in the U.S. shot past 13%. In Europe, double-digit inflation became common. But the real danger wasn't the price spike. It was people believing it would continue. Consumers, workers, companies, all were planning as if prices would keep rising. The U.S. Federal Reserve was in trouble. Markets doubted it could control inflation. The dollar weakened, gold soared. That's when Paul Volcker became chairman. Maybe not charismatic, but disciplined. He saw that inflation was no longer temporary and pushed interest rates sky high. The federal funds rate hit 17%, then 19%. Mortgage rates went over 18%. This was shock therapy. Unemployment rose, the economy shrank, but inflation was brought under control. And it didn't just affect the U.S. Latin America faced a debt crisis. Other developing countries were shaken. 1979 became the moment central banks realized credibility was everything. Inflation was no longer something to be ignored, and the lesson is clear. Stopping inflation is possible, but it comes at a cost: recession, unemployment, political backlash. Volcker accepted all of it, and trust was eventually restored. In short, the 1979 oil shock taught us this: money, trust, and psychology are inseparable. History doesn't repeat itself line by line, but if we don't understand it, it will catch us again. And remember, the fragility of the financial system sometimes reveals itself quietly, sometimes with shocks.